Hello everyone, Mr. Lipchick here, and our topic for this segment of instruction is the stock market. Buying stock. A share is a portion of a stock, in other words. Equities are claims of ownership in a corporation. There are different types of stock. Common stock is defined as shares owned by voting owners of stock, that is one vote per share owned, and preferred stock. These are non-voting owners of stock who are first to receive dividends in return of investment capital if the company goes bankrupt. Benefits of buying stock. Dividends, and these are shares of the profits paid out to stockholders, usually 4 times a year, that is quarterly. And capital gain, which is the difference between a higher selling price resulting in a financial gain for the seller. Stock splits, the division of a single share of stock into more than one share. Stockholders like stock splits because the shares tend to rise in value afterwards. Risks of buying stock. A firm's profits may be lower than expected, or it may lose money. Stocks may have to be sold at a loss. Creditors and bondholders are paid back first as the firm goes bankrupt, if the firm goes bankrupt. And because the risks of buying stock are higher, the returns are generally higher. So that is a bonus if you're willing to put up with the risk. How stocks are traded. They're traded through stockbrokers. A stockbroker is a person who links buyers and sellers of stock. A brokerage firm is a business that specializes in trading stocks. And they usually broker deals between investors and companies, but sometimes sell directly to investors. The stock exchange is a market for buying and selling stock. The New York Stock Exchange, or NYSE, is the exchange on which stocks and bond transactions for the largest and most well-established companies in the country, or blue-chip stocks, take place. The exchange has a limited number of seats, which allows members to trade. The OTC, or over-the-counter market, is defined as an electronic marketplace for stocks and bonds. Investors can buy stocks directly from a broker who will search the market for the best price. The NASDAQ, or National Association of Securities Dealers, automated quotations. This is the American market for the over-the-counter securities. Created in 1971 to counter the fragmentation of the OTC market by using automation. And it is the second largest securities market in the U.S. and the third largest in the world. And it links markets throughout the world. Futures and options. Futures are defined as contracts to buy or sell at specific dates in the future at a price specified today. Options are contracts that give investors the choice to buy or sell stock and other financial assets. A call option is an option to buy shares of stock at a specified time in the future. And a put option is the option to sell shares of stock at a specified time in the future. Here's an example of a call option. Begin with, you purchase a call option which permits you to purchase shares of stock at $100 per share in 6 months. You pay $10 per share for the call option. At the end of 6 months, the stock is now selling at $150 per share. You can purchase the stock for $100 a share instead of the market price of $150 per share. You have netted $40 per share by purchasing your stock. Using your call option of $150 a share minus $110 a share equals $40 per share profit. Example of a put option. You purchase a put option for $10 a share, which gives you the right to sell a stock that you do not own yet at $100 a share. The stock price falls to $75 per share, and you purchase it at that price. You exercise your put option and require the contracted buyer to purchase your shares at $100 per share. You've netted $15 a share on this transaction. $100 minus $10 minus $75 equals $15 per share. Now keep in mind with all these options that a great deal of risk is involved. Another phenomenon that has emerged is something called day trading. Day traders are investors who do not buy stock in order to hold on to it and watch its value grow. They make many trades per day using computer applications to predict the behavior of the market. They try to make minute-to-minute predictions in the market to buy low and sell high. Because of its highly speculative nature, day trading is very risky. That concludes our discussion of the stock market. Thank you for viewing, and I look forward to seeing you in the live lesson. Have a great day.